Welcome back to the deep dive. Okay, it's Tuesday, February 3rd, 2026. If you're listening to this, just take a deep breath. You made it.
We survived.
We survived the single most transformative 12 months in the history of the digital asset landscape. Today, we aren't just looking at charts. We're looking at the rule book that changed the world.
It really has been a whirlwind, hasn't it? I mean, if we went back to, say, early 2025, and I told you that by now, major U.S. banks would be the primary custodians of Bitcoin.
Yeah, right.
Or that you'd be moving tokenized U.S. treasuries on a Saturday night, you would have called me delusional.
Absolutely. I would have said you were dreaming. I mean, the sentiment just a couple years ago, the whole idea of crypto and compliance was like mixing oil and water. But here we are. And to understand how we got here, we are digging into this dense but incredibly valuable legal alert from K&L Gates. It's titled Crypto in 2026, the Democratization of Digital Assets.
And I love that word they use, democratization, because, usually in crypto, when you hear that word, you think of the early days. Power to the people, be your own bank.
Right, the hoodie in the basement, the Wild West mentality.
Exactly. But that is not what K&L Gates means here. In 2026, democratization it's a legal term. It means access without fear.
Fear of what? Getting scammed? Rug pulled?
No, fear of the government, fear of enforcement. For a decade, the biggest barrier wasn't the tech, It was the threat that if a U.S. institution touched this stuff, a regulator would come knocking.
Oh, okay.
The theme of this past year has been removing that threat. It's about the regulatory green light.
So it's less power to the people and more permission for the powerful.
In a sense, yes. It's about opening the gates so the big, established players can finally get on the field without worrying about stepping on a landmine.
And we do have to talk about the context here.
The political side.
Yeah, the source material mentions it directly.
Yeah.
The Trump administration's stated goal to make the United States the, quote, crypto capital of the world. And we have to mention it because that policy drives the regulation. Whether you agree with it or not, that stance set the tone for a massive pivot in late 2025.
It did. It signaled to the SEC and the CFTC that the goal was no longer to, stifle the industry,
right,
but to integrate it. The mandate changed from containment to adoption.
So let's talk about that integration. Because for the longest time, the relationship between crypto and the SEC was, let's call it adversarial.
That's putting it mildly. It was a Cold War.
So what was the Berlin Wall? If I was a CEO of big bank in 2024, what was legally stopping me? Why couldn't I just stick Bitcoin in the vault next to the gold?
It all comes down to one really unsexy but critical concept. Custody.
The plumbing.
The plumbing, exactly. It's just the legal term for who holds the assets and how do we keep them safe. Under, what the source calls the Gensler era, there were rules that made it almost financially suicidal for a bank to hold crypto.
You're talking about SAB 121? Staff Accounting Bulletin 121?
You've done your homework. Yes, SAB 121. It sounds like boring accounting code, but it was a poison pill. It said if a bank holds crypto for a customer, the bank has to treat that crypto as a liability on its own balance sheet.
Okay, let's unpack that. If I put $1 million cash in a bank, the bank doesn't have to hold $1 million of its own money to offset that.
Correct. But SAB 121 said if you put $1 million in Bitcoin in the bank had to set aside $1 million of its own capital. It made the capital requirements so high it just wasn't profitable. It was a soft ban.
Got it.
But as the source details, in 2025, the SEC formally rescinded it. They also withdrew the proposed safeguarding rule.
So the poison pill is gone. The handcuffs are off.
Gone, and then the floodgates cracked open. But the really interesting part, and this is where K&L Gates gets into the weeds, is a no-action letter from September 30th, 2025.
Okay, explain that. No action letter. Sounds like a regulator saying we're not going to do anything. Why is that a big deal?
In the legal world, a no-action letter is a golden ticket. It's the regulator saying, if you do exactly this, we promise we won't sue you.
It gives you certainty.
Total certainty. And this letter cleared the fog for state trust companies.
Which are the entities that handle wealth management, estates, that sort of thing.
Exactly. The letter allowed them to act like banks for holding digital assets. But, and there's always a but.
Of course.
There were strict conditions. You couldn't just, write the private keys on a Post-it note.
I would hope not.
The source outlines them. First, a written agreement guaranteeing the assets are segregated. No commingling.
That seems like common sense after, FTX and all that. Commingling was the original sin.
You would think, but now it's codified. Second, and maybe more important, is the rule on hypothecation.
Hypothecation. Okay, what's that?
It's when a bank takes assets you own, your stocks, your Bitcoin, and uses them as collateral for their own loans and trades.
So they're basically borrowing my money to gamble with.
In a cynical sense, yeah, and it introduces risk. If the bank makes a bad bet, you could lose your assets, the no action letter says. You cannot do that with digital assets unless the client gives explicit prior written consent.
Wow. Okay, that's a huge shift.
It is. So following that, the SEC clarified that broker-dealers, the apps we all use, can hold digital asset securities.
As long as...
Provided they have direct access to the vaults and do a full assessment of the distributed ledger technology, they have to know the code is safe.
So the aha moment here is that the wall between a crypto exchange and a stockbroker is just... it's crumbling.
It's gone.
My stock app can now legally be my crypto wallet with the blessing of the feds.
That's the great merge. And now that banks can hold the assets, the next step was fixing how they move. Which brings us to tokenization.
Yeah, this part really caught my eye because it's about the DTCC, the Depository Trust Company.
The backbone of Wall Street, the engine room.
Right. Most people don't realize that when they buy a stock, they don't actually hold it. The DTCC does.
That's right. They settle trillions of dollars a day. And on December 11, 2025, they got their own no-action relief to launch tokenization services.
So are we talking about, like, a DTCC meme coin?
No, definitely not. We're talking about the bedrock of the economy. The source lists the assets. Securities in the Russell 1000, U.S. Treasuries, and major ETFs like the S&P 500.
Okay, but why? Why do we need a tokenized treasury bond? The current system works, doesn't it?
Does it? I mean, imagine you're a global firm. It's Saturday night in Singapore. You need to post collateral immediately. You've got $1 billion in U.S. Treasuries sitting in New York. Can you move them?
In the old world? No way. Markets are closed. You're stuck till Monday.
Exactly. Your money is frozen in time. But in this new program, the relief allows for 247 peer-to-peer transfers between approved wallets. You can move that $1 billion instantly.
So it unlocks liquidity.
Yeah.
Turns static assets into liquid ones. 247.
It's a massive efficiency unlock. But I notice a key restriction in the source. It says these tokens can't yet be used for settlement value to manage default risks.
So it's a test run, basically.
It's a sandbox. The relief is for 3 years. They're saying, okay, move the tokens around, prove the tech works, but we aren't going to let you count them toward your net debit cap yet.
Net debit cap tap.
Yeah.
Sounds like the credit limit for the entire financial system.
It essentially is, yeah. It's a safety mechanism. They don't want to put the weight of the entire economy on this new blockchain plumbing until they're sure the pipes won't burst.
Okay, fair enough. So we have the SEC letting banks in. We have the DTCC tokenizing stocks. But we have to talk about the other heavyweight, the CFTC.
Right, the Commodity Futures Trading Commission. And this is where the story gets surprisingly harmonious. Usually the SEC and CFTC are fighting over turf. But in late 2025, Michael Selig was confirmed as CFTC chairman.
And why is he important?
His resume. He was the former chief counsel to the SEC's crypto task force. He speaks SEC. He used to advise the current SEC chairman.
So for the first time, the two parents are actually talking to each other.
Precisely. And Selig inherited this initiative called the Crypto Sprint.
Sounds like a hackathon.
It was a 12-month regulatory blitz. The goal was to clear the backlog of applications, and it worked. The source confirms that as of late 2025, spot digital assets are finally trading on CFTC-registered exchanges.
Okay, that's big. But I want to zoom in on the money side of this. The collateral changes. This is huge for traders.
It is. On December 8th, 2025, the CFTC issued guidance for FCM's Futures Commission merchants.
The firms that handle futures trading.
Right. The guidance lets them accept crypto as collateral. Before this, if you wanted to trade oil futures, you had to post cash. Your Bitcoin was just dead capital. Now you can use it.
But not just any crypto, I assume.
Oh, no. The list is very short. For the first 3 months, it's limited to payments, stablecoins, Bitcoin, and Ether, the blue chips.
Still, that validates Bitcoin and Ether as high-quality collateral. That's a huge psychological shift for traditional finance.
It is. But the FCMs are on a tight leash. They have to file weekly reports on what they're holding. And this is crucial. They have to immediately notify regulators of any cybersecurity events.
They're terrified of a hack.
They're terrified of contagion. If an FCM gets hacked and loses the Bitcoin collateral, who covers the losses? They want to know within minutes, not days.
Okay, that makes sense. So banks, stocks, futures. But what about the actual currency, the stablecoins? This brings us to the Genius Act.
I love the names they come up with. The Guiding and Establishing National Innovation for U.S. Stablecoins Act.
Rolls right off the tongue. The Genius Act.
Enacted July 18, 2025. This was the first major standalone digital asset legislation to actually pass Congress.
And what problem was this solving?
Legitimacy. Before this, stablecoins were a gray area. Were they money, securities, who audits them? The act created a federal definition for payment stablecoins.
And who gets to issue these legit digital dollars?
It's not a startup in a garage anymore. It's restricted to authorized subsidiaries of banks or entities licensed by the OCC.
Legitimacy through bureaucracy.
In a way, but it provides safety. These issuers are subject to bank-like regulations, reserve requirements, redemption guarantees, AML compliance.
But there was one detail that stood out to me. It felt weird. The act prohibits paying interest on stablecoins.
Ah, yes. The interest loophole. The act explicitly says issuers cannot pay interest.
But why? If I have dollars in a savings account, I get interest. Why not for my digital dollars?
It was almost certainly a concession to the banking lobby. They were terrified that if people could hold a stable coin in a digital wallet and earn 5%, no one would keep money in a regular checking account. It would cause a deposit flight.
So they crippled the product to protect the banks.
Initially, yes. But here's the twist. Now that the banks themselves are issuing these things, they're realizing they shot themselves in the foot. The source notes they are now lobbying hard against that rule.
Or finding workarounds.
Exactly. K&L Gates points out a gray area about rewards from affiliates, so maybe the stablecoin itself doesn't pay interest, but the platform you hold it on gives you loyalty points that look a lot like a 4% yield.
Yeah, always a cat-mouse game.
It is. And the infrastructure is building out. On December 12th, the OCC approved 5 national trust bank charters just for stablecoin issuers. So the banks are rushing in.
So we have the financial landscape, but there's a deeper layer in the source material. This section on privacy versus surveillance, this feels like the philosophical battleground for the next decade.
This is the most important part of the document, I think. The SEC's crypto task force isn't just looking for Ponzi schemes anymore. They're trying to solve a paradox. How do you have government surveillance to stop fraud while preserving the privacy that blockchain promises?
And the source mentions 3 specific technologies. I won't break these down because these acronyms are going to be everywhere. The first is POW, proof of work. We know that one.
Right. Bitcoin mining, that's the security layer. The foundation.
But the second one is the hot topic, ZKP, zero-knowledge proofs.
ZKPs are fascinating. The best analogy is a nightclub bouncer.
Okay, walk me through it.
To get into a club, you hand over your ID. The bouncer sees your name, your address, everything. You've given up all your privacy just to prove you're over 21.
Right. She knows where I live now.
Exactly. A zero-knowledge proof is like a magic ID that just turns green when he scans it. It proves you're over 21, but reveals 0 other information.
And in finance.
It means I can prove I have the funds for a trade without revealing my account balance or my entire transaction history to my competitors.
That's a game changer for institutional privacy.
It is. And that ties into the third tech, MPC, or Multi-Party Computation.
This one sounds complicated.
Think of it like a secret recipe problem. 3 chefs want to combine their secret spices to make a sauce, but none want to reveal their ingredient.
Okay, they want the result, but not to give up the formula.
MPC lets them mix the ingredients digitally to get the result, the sauce, without anyone ever seeing the individual inputs. It protects proprietary trading strategies.
So we have the tech to make markets private. But the SEC wants to see everything to catch bad guys, right?
And that's the tension. They acknowledge this tech is great for business, but they are worried about insider trading. If everyone is using zero-knowledge proofs, how do you prove someone acted on non-public information?
It's like everyone is wearing an invisibility cloak.
Exactly. The source notes the SEC is going to spend the rest of 2026 trying to figure that out.
So, looking ahead, what are we watching for the rest of the year? The source mentions the Clarity Act.
The Digital Asset Clarity Act. It passed the House last July but got stuck in the Senate.
Classic. What's it supposed to do?
The Genius Act was just for stablecoins. The Clarity Act is the grand theory. It tries to finally draw a hard line between SEC and CFTC jurisdiction to answer the eternal question, is this token a security or a commodity?
And with Chairman Seelig at the CFTC, the prediction is harmony.
That's the hope. The expert opinion in the source is that 2026 will see the end of the turf war. We're moving toward a harmonized framework.
And we are seeing more companies just asking for permission first now.
Yes. The ask for forgiveness, not permission era of crypto is officially dead. We are in the ask for permission, and you might actually get it era. It's less exciting, maybe, but it's sustainable.
So let's synthesize this. We went from a regulatory blockade banks, terrified to touch crypto, to a world where SAB 121 is gone, U.S. Treasuries are tokenized, and you can use Bitcoin as collateral, all in about 12 months.
It's a massive maturation of the market. Crypto isn't an alternative asset class anymore. It's just part of finance. It's boring now, which is exactly what it needed to be.
But, as always, we want to leave you with something to chew on.
We do. And for me, it goes back to that privacy discussion. The government is getting comfortable with crypto because they can regulate the banks. They can see what the banks do. But at the same time, the technology is evolving to hide more than ever before with ZKPs and MPC. So here's the question. As these two forces collide, the government's desire for total visibility and the tech's ability to offer total privacy, who actually wins the tug of war for your financial data?
That is the billion-dollar question. Are we building a transparent utopia or a surveillance panopticon? Something to think about.
Indeed.
That's it for this deep dive. Enjoy the new, safer, and maybe slightly more boring era of crypto. We'll catch you next time.